Welcome to the Deal by Deal podcast. Today we're going through the third quarter performance. We have assets across all different real estate categories. So today we're going to dive in and look at how each of them are performing and trends that we're seeing. So you guys ready?
Always ready.
Always ready.
Always ready?
Yep.
Cool. Okay, so first kind of point is like we think it's a buyer's market or seller's market.
Oh, boy.
I'm going to take the stance as a buyer's market.
Yeah. What are you thinking, Andrew?
Well, based on our deal volume right now, it's definitely
Based
a buyer's
on deal
market.
volume?
And what we're buying, it's definitely a time for us to buy, if you could find something to buy, that is.
By defining it as a buyer's market, we're basically saying it's not a seller's market. So what we're experiencing is it's very challenging to sell something. It's also very challenging to buy something, but it's incredibly challenging to sell something right now.
Well, yeah, selling is well, the stuff we're trying to sell right now, the volume on it is very low, and the only thing that's really selling are premium sort of, hey, this is shiny and new and great. Okay, I'll look at buying that. But anything other than the top tier of whatever we're selling is just not getting looked at.
We've seen a lot of deals trade that are trading at 20, 30, 40% discounts to the prior market. So that's kind of sexy in its own way. They're buying kind of super distressed stuff, like our film studio deal that we just bought.
Right.
We bought that for 50% off.
And how much? $100? How much was it a square foot?
$77 a square foot.
$77 a square, and $77 a square foot's way below what it costs to actually build. Right. And don't forget what's under all of this, though. Underneath all of this is
dirt.
Something about a bank. What banks charge us? Have you heard about this thing where banks charge interest for?
Interest rates are definitely high.
Yeah.
But if we even think on top of interest rates, all the offers we're getting on deals, stuff we tried to sell at the beginning of the year, we still haven't exited yet. Offers are looking like 45, 60 days of due diligence. So we're talking 100-day plus contracts. That's hard to get anything done.
Right.
And
when you give somebody a 45-day due diligence cycle and they use it all, and on the 44th day they cancel their contract, you've used a lot of time and burned a lot of time. That's a month and a half of wasted effort.
But don't forget about the 30 days you spent negotiating the contract just to go live.
There's that too.
So you're talking 60 plus days just to get through due diligence.
Just to get to a no.
Yeah.
Yeah. So market right now is definitely looking more like a buyer's opportunity if you can actually get deals through and you can actually buy them. Selling is really tough right now.
So I don't like this market. Can we change it?
Well, it depends if you want to go look for some good deals.
If you could find them, but then we're also talking about
how you be on both sides.
Yeah.
You need to sell at the right times. You need to be able to buy at the right times.
Right.
So right now is definitely more buyer opportunity. You think that way in retail too?
Well, it's interesting you said that because retail has two headwinds. I mean, actually, we have three headwinds. We have interest rates because whenever you're buying a retail product, you're always buying it on the spread between a cap rate and debt because it's not a sexy deal. It's a pretty stable performing deal. And so you're buying it on that spread. But then you're also dealing with headwinds of just the marketplace, of retail in general, tariffs, the economy, consumers. We were looking up consumer sentiment the other day. I remember consumer sentiment has since
been kind of ticking down.
It's ticking down since COVID.
2020.
Yeah, since COVID.
It looks like it's actually on par with the COVID era sentiment.
It was pre-COVID. We looked at it. It was pre-COVID. It was like 2016 or so.
Oh, yeah, we're back to like 2016 levels.
Yeah, 2016 consumer sentiment. And so then, you have a product that's kind of stable, but then you have the headwind of a lower spread, and then you have the headwind of the economy around it. So it's interesting. Yeah. But however, we're buying deals. We're buying a couple of deals right now that we've never seen this cap rate ever. You make your money in real estate when you buy. Yeah, you don't make your money when you sell. You
should only spend money when you buy. You make your money when you sell the thing.
Well, you make money when you sell it, but
when you buy, you give other people money. When you sell it, you get money.
You're making your money on a good buy,
and
then
paper,
when you sell, yes,
paper, you're making money
because you're always buying it below market, and then hopefully you're selling it at market or a better premium when you sell it.
So buyer's market, yes.
Buyer's market, yes, but still not a clear buyer's market. A kind of strange buyer's market that with I'd say lower volume than you'd expect.
I mean, when we started buying multifamily, all of us, back in the 2010 to 2015 era, we didn't know which way it was up.
Every single $20,000 a unit property we saw, we should have just bought, even if we couldn't. We had to scrape, borrow, and steal that.
That was one of the best buyer's market ever, and you didn't know it until it was already.
But at the worst times.
You didn't know it until it was already turning into a seller's market.
Yeah, you didn't know until it was already over. And so, maybe we're really smart now in buying all these deals, and then in 5 years we'll say, oh, wow, look at that.
Yeah.
Yep. All right. So next subject, something that's come up a lot over the past 2 years and really in the past 6 months has gained a lot of, there's a lot of discussion around it. There's a lot of funds that are coming out and doing it, but that's this concept of private debt and what does that actually mean? So there's essentially plenty of deals that need rescue capital where you can come in, bring private debt on the backside of a challenging deal to maybe help get it turned around in the right direction. But there's also numerous different ways you could look at this private debt kind of situation. For a long time, it felt like private debt was more of a house flipper type market where you have a hard money lender doing something short term in the teens rates and looking at maybe a house that they're going to flip and exit. That was out there. There was a lot of people, we had heard about that kind of stuff and we had not been involved in it. But now we're looking at how can we issue private debt where it's really the first piece of debt and not secondary or third position on stuff.
Right, and don't forget when we're doing private debt, we're pushing the risk outside of us because we're essentially in the property for a very low cost basis. And so if everything were to go bad, we would still get paid.
Yeah. And we've done this, we've done our own private debt where we've done it on retail deals. We did it with seller financing where we issued roughly a 18% loan to value position on a deal that we sold. So first position on a deal that we understood, we're like, hey, we're pretty happy with that. But as of now, this whole kind of private debt thing has picked up significantly.
Yeah, I think there's lots of different ways to look at it. One, the way that we're looking at it is more from a growth mindset, opportunistic, that the person we're lending to is looking to grow and grow beyond the current status of the deal. The alternative way of looking at it is kind of bailout private debt, which we're trying to stay away from, which is the guy that's underwater, he can't afford the deal, he's upside down on it, he needs to wipe out his equity, and he needs a replacement capital to come in to save things. We're trying to stay away from that. That's a lot of what's going on in the multifamily world right now that we're trying to keep
avoiding.
Avoiding.
But it's there.
It's definitely there.
I would like to do that. You wouldn't like to do that?
Secondary position?
Not secondary position, but bailout debt if it's primary position, not secondary position.
Most of the stuff we're seeing is secondary position.
Secondary
so
position.
The loans are the main mortgage is already in place. You're upside down, so you got negative cash flow. You got investors, and you got to bring in new capital to kind of reset. Or you're not getting rid of that first loan.
Why would anybody take on that second position?
You can still look at the math, and maybe there's opportunity there.
Maybe, yeah.
So, like, let's say they bought the deal for $180,000 a unit. They have a first loan at $120,000. They're basically wiping out their equity, saying, "Hey, will you come in from $120,000 to $150,000?" If you believe the growth of the apartment market, it's not a bad position to be in.
If it sells for $180,000.
If you think it's worth $180,000.
Yeah, and then are they getting equity positions for the holding that second position?
No, normally. Yeah.
So they're really just getting a rate of return, and I guess they're getting
if they can.
Yeah,
but they're get it paid.
But they're probably also getting hard money type of rates with 15, 18%.
High teens, yeah.
High teens, yeah. So it could be worth it.
Maybe. So we haven't done any of those deals,
no.
But that's definitely out there. We have done, really wrapping up this quarter, we've done about 17 deals in the private debt space where we're loaning traditionally more first position, more non-rescue capital. Those have been working really well. We see that market performing mainly because banks are taking a long time. We look at time to do a deal. A lot of that is bank timelines are pretty long. There's a lot of fees on the in of the deal with closing costs and bank fees, and there's fees on the out of the deal when you're selling it back to the bank. So if you only need it for a year or two, the private market for capital can be a better opportunity right now.
Yeah, like some of these land deals we're doing, they're getting a primary mortgage for 50% of the deal. We're coming in between 50 and 60% of the deal, and then they're raising equity for 60 to 100. So it's like our position is, number one, it's relatively small for the deal. Number two, it's just above 50% leverage. It's that first tranche there. So we feel like it's a good position to be in. It's creating opportunity for the developer to basically build out and expand their business. So it puts us in a really good place.
Yeah. Next thing we want to go through is our software spend. This is a big component of our cost structure as we look at operating different real estate assets. We've touched on insurance. We've touched on taxes. But one of the next big ones we have is software. Literally everything that happens throughout, throughout the business operations is run by software. Maybe 10 years ago, we were really excited because we were getting people to pay online. And it was like, wow, this is saving a ton of time and energy. We used to track what's our online payment adoption, right? And now that's just the standard. However, as we look at software over the past year, things have really shifted where the cost of software has become exponentially more expensive. Every year, kind of, we get our renewal offer of here's a software package you're using, here's what the renewal cost is going to be, and it's like, oh, everything is thousands of dollars a month, and it can definitely get to a situation where it's cost prohibitive for a business to even use some of these features. So what we've really done is take a look at how can we utilize AI agents that can help us make our own software, where we can replace software applications that we're using with really more of a kind of like toned down version of it that has the core features we want, that we want to be able to use, that works with our process, and deploy that.
Yeah, so a lot of this stemmed from us using Salesforce a couple of years ago. We signed up for Salesforce. It was this kind of big, convoluted, 100-page contract that we signed with them for multiple years, and then we had to go find a consultant that we had to have like a monthly spend with to train us how to implement Salesforce, teach us how to use it, teach the software how to work with us, and then train us how to do all these things. 18 months into it, we still didn't know how to use Salesforce, and we had spent well into the six figures, and we were insanely frustrated. And we finally just scrapped it and went back to kind of just documenting things in Excel.
Yeah, we literally used like a Google Sheet for a while. We're like, we'll just write it down. This seems like it could be more efficient.
Oh, I mean, I couldn't even figure out how to log into, the little Einstein guy in Salesforce. It was driving me crazy. But so in the meantime, Dave's been working on these AI agents using Replit, right?
Yep.
Replit to really program, and we've really just been hammering through what are the key features that we use and what do we not use. So one of the things that Salesforce does, and it does it very well, so I'm not criticizing Salesforce, it just wasn't right for us. Salesforce would read all your emails and kind of dump all that data in there. And what we found is that when we were searching for conversations and information, that it was just very muddy information because all this email content was just constantly being dumped in. So we said, listen, we don't want the email content. We really just want the conversations that we're having to be more personalized information. So when Dave was building this CRM with Replit, we removed the features that we don't want to have, like that.
Yeah, we're just focused on what are the core things that we need to have from this piece of software, and how can we use it in our business. So we've done that with our CRM, but we're really going through every segment of our business and saying, how do we do stuff? And is there a way we can create a piece of software that's custom to us, easy to manage, that can help us do that more efficiently? We look at just spend overall in a business. We have to find a way to do things more efficiently every quarter. That has to be a big component of any business. Like, how do you do this more efficiently? How do you do it better all the time? And that's really part of what we're using software to do. Now, the other part, like we use not only making software, but making sure we're using AI and doing different prompts and figuring out how can we bring it into our business. And a big part is just lease renewals and contract negotiations that we're going through with ChatGPT, really, to look at our lease abstracts.
Right. Well, yeah, for lease abstracts, we used to pay like $1,000 for a lawyer to look at a lease abstract. And now anybody, even our interns, were doing lease abstracts this past summer. And so, you want to pay a lawyer $1,000 to do a lease abstract, or do you want to pay an intern for, in 10 minutes, they're generating the same essentially quality document that an attorney used to do for $1,000.
And they're probably learning something as they go through the process in doing it, because you can then just interact with it and ask it more questions about the lease, play out scenarios, and go through it.
And even our marketing material right now, instead of like a multi-day, multi-person project to generate a marketing document, now you just ask ChatGPT, hey, here's the lease, here's the property address, here's some very basic details about the property. Tell me about the property. What are the property highlights? What are the highlights about the area? What are the top businesses in the area? And ChatGPT will spit all of this content out for you to actually put in the marketing document. And so, it has essentially moved this process down from essentially I'd say, days or weeks to hours or days. And so it's a significant saving. So someone defined AI to me as a competent employee. Essentially right now we have a competent employee for $20 a month with ChatGPT. So I'm a believer.
Well, the nice thing about the lease abstracts is, going back to your point on that is, a typical lease that we're signing or inheriting, a lot of them we're inheriting, they're 50 to 60 pages long. They're really, really, really hard.
And 40 pages of useless information.
But a lot of times the information on page 2 will conflict with page 37, and you can't. It's really, really hard to find that. So using the agent, the AI agents to really dig through this, surmise it, and one of the points you brought up earlier was, is there anything in here regarding the HVAC? Is there anything in here regarding
who's responsible for fixing the roof?
Right.
Like you can ask the AI agent
and have a conversation with it just like you would a person.
Yeah.
And we're taking that and, taking it even further and saying, hey, here are all the leases that we currently have. So we can ask that questions about how these leases are performing. Are there any inconsistencies in how we operate versus how the lease are signed? So we can really make sure we streamline how we operate a business with what the lease document says and how we communicate with our tenants. It just tries to make that whole process more efficient and more accurate. And in the end, I think we'll have a better tenant experience that's there, but we'll also have a better understanding of just how we execute the business plan.
What did you say? 7% of people actually believe AI is useful, or what was the
statistic? That was a survey I saw on, it was on X. It was like commercial real estate professionals. How many people think that there's going to be a positive impact to your business in the next year because of AI? It was something like only 7% said certainly. And they have all the different grades of like certainly, maybe so, I think so, I don't know. But it was like 93% were in the other category and 7% were in the definitely. I was just trying to, how do you be in the 93% where that means you're not even using it to just like review a lease? Yeah.
And we've looked at a lot of our competition, and they're a lot of our competition out there, meaning the other groups that buy stuff. What they're boasting is that they use all these incredible tools, which they are great tools, like an Argus or a VTS or DealPath. Right, these are great tools to use, but they were a lot better. They were a lot better when they were the only tool to use. Now that there's AI agents out there that can really do a lot of this work for you, they're becoming less and less valuable. And if they don't innovate, they're not really going to have a place in the market. So we were really suspect of signing up for all these additional tools all along. And it's actually been to our benefit because we didn't sign up for them. So now we're using AI to really do a lot of the function that they provide.
Yeah, and then we're having this, kind of internal battle where we say, like, this is how we want to operate as a business. This is a swim lane we want to go down. But you sign up for these different SaaS platforms, and they're like, okay, hey, this is your new business methodology. And it's like, we don't want to do it that way. Yeah. We want to do it our way. And sure, we think it's better, but SaaS had its own way of doing it. So you get too much software and you have too many people that basically telling you how you're going to operate your business, and you lose your ability to have that control and do what's unique and makes your brand special. So I think you got to be careful with the SaaS part of it. We're kind of heading in this, how do we make our own applications that work for us, help our people do the processes we want to see, and we're going to go down that path.
Right, and that's exactly why we moved. I mean, Juniper Square was a great tool for almost 10 years we were with them, and it's still a great tool for certain syndication groups. But we found that moving to Agora, that's more focused on the individual investor instead of fund structure, an individual deal compared to the fund structure. Agora was a better fit for us, so we ultimately had to move away from Juniper Square over to Agora.
Yeah, we're constantly looking at that software. Every time a renewal comes up, is like, is there a better way to do this, and is there a way we could just do it ourselves? Right. All right, let's dive into the residential segment. This is something, we've been operating residential real estate in the sense of apartments and mobile home communities for the better part of 15 years. So we've been doing it for quite a while.
Well, you guys are old. 15 years. Holy moly.
I wish it was 5. We'll round it to 5.
Dave had like a full bushy hair.
You had hair when you started.
It was that long ago.
It was like bushy and flowing in the wind.
My God.
I had no grays. It was really
strange.
So
this is what the real estate business has done to you too: gray hair and no hair.
Or maybe his 3 kids, my 4 kids. That could have been it too.
I think it's real estate, but all right. So our quarter, right? How things are going? Our view on apartments and mobile homes right now. The third quarter, we saw really a contraction in our revenue. The first 2 quarters were very strong on revenue gains. So the third quarter, we saw a dip of 3% off of second quarter, where basically then takes us back to where we were at the beginning of the year from a revenue standpoint. And on that, our controllable expenses this quarter were up around 13% this quarter over a year ago, and our non-controllables were up as well about 8%. We look at controllable expenses as things like landscaping, maintenance, wages and salaries, that kind of stuff. Non-controllable is really just taxes and insurance. Taxes and insurance make up our largest spend buckets across the types of assets that we operate. So we break that apart, and it's highly important for us to be able to manage how those are performing. That being said, the biggest metric we look at in the residential space is our retention. Our retention was 72% this quarter. That means, out of 100 people, 72 people renewed their lease with us. Our target is 70%. So we see that as if our retention is really high. We're either doing a really good job servicing our properties, or we just have a really affordable rental rate. If our retention is low, that means, hey, maybe we're not doing very good, or our rental rates are too high. We either need to lower our rental rates or do a better job serving our residents. That's how we look at that retention number we're at right now. So overall, our biggest thing we're seeing right now in the residential space is we have strong occupancy, we have strong retention, revenues facing headwinds, and currently we're in the kind of third quarter, fourth quarter, our tax rates that are going up. We have to find a way to be more efficient in how we operate to pay our higher property taxes. One of our examples is a 100-unit deal we have where our taxes went up about 1,000 units, $1,000 per unit. So we had about $100,000 tax increase on the property tax bill. So now we've got to go find a way to reduce our spend in the controllable operating expenses. We can't do it really in the tax part. We can't always do it in the insurance part either.
Well, we did it in the tax part because they tried to increase our taxes $200,000. And
I don't know if that counts as a win.
Yeah, but we cut it back to $100,000. So
most of the time we are appealing our property tax, and we'll get some savings, but it's more like, we were going to increase them 120%. You got rolled back to 100%.
Right.
So, but the other part that's interesting on insurance, which we consider non-controllable, the group we went with this year, they were an AI-based insurance company in their marketing, but we did save money on that this year. They went through and underwrote all of our deals and our properties very, very quickly using AI, where we basically upload our information. They were able to get through that, and we saw a reduction on our insurance costs this year, which was great. That was positive to see, right? So transaction-wise, we look at are we buyers or sellers of residential right now? And we're still net sellers.
Yeah, the last residential deal we bought was in 2019. We started selling in 2018. We've been net sellers since. We had a portfolio of well over 4,000 units. Now we're down in that 1,000 unit range. And we're looking at kind of the last couple of our apartment complexes, especially our out-of-state ones. Do we sell those? We're looking at our mobile home portfolio. Is this the right time to be selling those? And kind of opportunistically positioning those for really peak exits. Some of our mobile home parks have just been performing so well for so long. We're looking at saying, you know what, if there's a buyer that wants to come by and buy it, kind of this, incredible performance, they think they can take it to a whole nother level, we'd be happy to sell that. So we're looking at exiting some of our mobile homes, and the apartments really opportunistically, selling those as well.
Yeah, we have a few of these. One of the mobile home deals we're looking at selling. It's really like a 6-7 month process to get some of these things off the books. It's going to be a good exit for us. We're very excited about it, but it is quite a lengthy process to sell stuff right now.
Right.
One of the other metrics that we look at when we say how do we assess whether a deal is doing well or not is a metric we look at as revenue to our basically book value or fixed assets. And anytime you do a CapEx improvement, you're increasing your fixed assets, and we're not, in the technical part, we're not knocking off depreciation from that. It's like true full fixed asset price. But right now across our residential portfolio, we're around 22% revenue to fixed asset ratio. So for every, call it $1,000 in fixed assets, which can generate $220 in revenue. It's kind of like an equalizing term when you look at all residential deals. And even from that, we still have some tightness in how well we operate. We still have to fight to make sure that we can control our expenses. If we do see an expense rise, we have to find a way to offset that so we can either maintain or improve our operating margins. The deals we have that we're selling, right? Buyers kind of coming into this stuff are normally buying in the 8%, 9% revenue to fixed assets. And that's where we're sellers. For us, we can't make the numbers work at those price points. Our lowest is 12.8% revenue to fixed assets. So when we look at these numbers, it's a way we can compare, prior to operating ability, I would say, across multiple deals. See where we're at.
Right. And a lot of our properties we bought, 7, 8, 9, some 10 plus years ago, that our basis is so low. And, our core focus is retention, keeping residents in the units, keeping occupancy there, that sometimes we miss out on the rental increases. And we're getting 3 to 5%, maybe 7% rental bumps, instead of letting that unit go vacant, renovating that unit, and getting 15 to 20% rental bumps. As when you go to market with a property like that, and our rents are say $1,000, $1,100, and the market might be $1,200 or $1,300, that's an opportunity for the buyer to come in and kind of pay halfway. So if the deal at full market is worth $150,000 a unit, we're happy to sell it $120,000 a unit, so they can basically invest that money and get a full market rent.
Yeah, they got some work to do.
Yeah, they definitely have some work to do.
Yeah,
but we've been happy, at our basis because of when we bought it and the price we paid for it.
Yeah, everything, it really comes down to basis when you're on these deals of how well is it going to perform, and ours have performed really well just because we have a great basis.
Mm. Right. So speaking of affordable housing, New Jersey has just auctioned off $500 million in tax credits to build affordable housing in their state. It's one of the first affordable housing, kind of statewide affordable housing programs.
So they auctioned it?
They auctioned it off.
So how much did they have to pay?
The article was talking about the $500 million auction off.
Oh, so you're buying it for $250,000 or $250
Maybe
million.
you're going to get the tax credit if you do the deal.
Yep.
Yeah.
So, but it's hard. I mean, even, we've had affordable housing deals before, or look at affordable housing. We've had deals that have had rent restrictions in place. But in the South, you can still increase property taxes on deals that have rent restrictions in place. So your margins are just going to get crushed,
right,
quite frankly.
And we have a couple of those deals that we've seen property taxes double and triple while we can't raise rents. It's just interesting.
There's not much you can do. Yeah, you're just stuck on a lot of those deals. So unless you're finding some way that you can ensure your non-controllables go in line with your rent, is essentially becomes a non-controllable on a lot of those deals.
Right, exactly.
Where you don't get to control it, doesn't get to fluctuate with the market.
Right. And there's a lot of buyers out there that will buy those deals and take them out of the program or wait for them to come out of the program. I mean, we bought them years ago when property taxes were much, much lower. And we've been riding them through the end of the program. One just came out of the program this year. Another one, I think, is coming out of the program next year.
Yeah, but I mean, or one that just came out that doubled the property taxes.
Yeah, so we have to get aggressive on rents.
But yeah, it's like it makes affordable housing really go away if taxes just keep going way up, right? So I mean, overall residential. That's why we're still a seller of residential as a whole. And again, we think it's a buyer's market out there in real estate right now, but we're seller of the residential side. Okay, let's dive in to retail. Andrew, this one's always,
retail. I've heard that before.
It's been your core focus, right?
Fiery?
Yeah, just exciting.
Exciting. Well, actually, no, retail's not exciting, which is why I do it, because retail's always steady Eddie. It always kind of just, how it's doing, and it's
Dollar Generals excite me.
Dollar General.
Oh, I'm sorry.
Well, stability and revenue is always nice.
Yeah.
And retail.
Right. Well, predictability.
Yes.
So retail, retail's thing is it's predictable. The valleys are lower. No, the valleys are less. The peaks and the valleys are a lot less than typical other properties. Like multifamily has a big up, multifamily has a big down. I mean, retail kind of stays in this range. But, retail is always a debt game. I mean, retail is the difference between what you buy it for and what your debt is. And so the bigger that range is, the better you do. Yeah. But, over the last few years, there's this something called an interest rate hike. Have you guys heard about this interest rate, these increasing interest rates?
We just had an interest rate cut.
Yes.
Not the first one.
Not the first one, but,
several.
Remember our old interest rates, like our best interest rates were in the 2s or 3s.
Yeah, those are...
ZIRP's over.
Yeah, that's
gone. I don't think it's ever come back.
Yeah, so people, think about 30-years buying houses right now, because I'm assuming three of us, well, my mortgage is almost done, but 3% mortgages or whatever, or even 2.5% mortgages, those might never exist for the rest of our lives,
But retail will probably always be here.
Retail will always be here, and interest rates might reset. They might go back down to the 5s, but are they ever going to go back down to the 3s or 4s in our lifetime? Probably not.
The biggest part in retail has been, cap rates were compressed. They were down. And some retail, I mean, even like a Starbucks is like a 4 cap. That's insane.
Yeah, I mean Chick-fil-A's.
Chick-fil-A's, it doesn't.
Yeah,
it doesn't.
they're
You might as well
super
buy
low,
a
but
money market.
If we look at the stuff that we're buying, and we're buying something that's in the lowest we probably did was in the 7s, and somewhere in the 9. We're looking at stuff in the 9s right now. With that being said, interest rates coming up has not. Interest rates have come up a lot more than cap rates have gone up. So really the spread between the cap rate on a retail deal and the interest rate is significantly compressed to where it was 2 years ago.
Right. Well, look, we used to buy a 7.5 cap deal and get 3.5% debt, and so we'd have a 4 points between cap and debt. So now, if we're buying a 9 cap deal, we need to have that. We need to have
At
debt
a
at 5.
It's not.
And there's
it's not there.
Right, debt right now, the best debt we've gotten over in fact, we just got quoted debt on 2 new deals we're buying. We're buying the deals in a 9 cap, but the debt is going to be 6.15, which is amazing debt.
That's good right now.
The deal cash flows and does well, but it's just a different market. And even like DGs right now, I know you get excited about DGs, but we used to buy DGs like in the 7s and be elated, and then we started buying DGs in the 8 cap range and we were elated, and now we've got 2 DGs under contract right now for like a 9 and a 9.5 cap. It's like, holy moly. And I think in 3 years we're going to say, wow, we're glad we did that, because it's not going to happen again. That might not happen again in our lifetime. Like a 9.5 cap DG
also,
or a 9 cap
when
DG.
we were buying, our game plan in retail has always been to just buy a shorter term lease, sign a longer term lease, so we can exit at a lower cap rate.
Yeah.
The cap rates we're buying at are typically shorter term leases. However, the recent 2 we looked at here are
they're typical
4 to
5
5-year leases,
yeah.
and still at a 9 cap, which means when we go to like exit that thing, we need to have an even longer lease in place to sell at a lower cap rate.
Or a rent bump.
Or
a rent bump, and we sell at the same cap rate with the rent bump. So it's kind of the same thing. And so
I think part of this is just telling the story that we talked about earlier of just kind of the buyer's market. Like, deals are just really hard to put together. Banks are really hard to pull together, and these are smaller Dollar Generals, like under $1 million.
One's under $1 million, one's just over $1 million. But
right,
yes.
so they're a little bit hard to finance. They're just kind of a needle in a haystack. But together, it's great. We're building a really nice portfolio of Dollar Generals that at someday we can look at combining them, separating them. Really, we have a lot of flexibility of what we do with them. But in the meantime, we own it at a 9 cap, so we have a lot of flexibility on what we do with it.
Yeah. And so if we sell it, we sell it at an 8.5 cap one day.
Exactly. Yeah.
Which, and over the 20 years, if you just look at the Dollar General progression of cap rates, like literally over the last 20 years, I mean, there are some ups and downs, but progressively, the trend line shows it's going down over the past 20 years.
Cap rates going down.
Cap rates going down. Prices
are only getting more expensive.
As cap rates go down, prices are going up. So literally for 20 years, the price of a Dollar General has gone up, up because the credit of Dollar General, the reliability of the business, the stability of the business. In fact, some of the favorite things, people buy right now, they just buy a 15-year-old Dollar General at a 6 or 6.5 cap, and then they have stable income for 15 years, and they have some they have almost a surety that for 15 years, they're going to be paid rent. Mm-hmm. And so if you're 60 years old and you have 15 years of reliable income, and then, you could sell it for, whatever at the end of the 15 years, we've done pretty well.
One of the biggest opportunities in retail has always been to find things that are either a shorter term lease or new ownership, and then sign a longer term lease, and that's where that value is created and it can be sold.
Yep.
One of those happening right now is this happened in the past 5 or 6 months here though, but Family Dollar and Dollar Tree.
Oh my God, it's horrible.
Right, so there, you would drive around, you'd see the stores that says Family Dollar and Dollar Tree on the same store, which those stores actually had better sales than the standalone ones, which is a little weird. However, they broke apart. So Dollar Tree purchased Family Dollar in 2015 for $9 billion, and they just sold them to a private equity group for $1 billion. We look at these opportunities, and we saw this before with Applebee's. When Applebee's went bankrupt, and their cap rates basically went up because people were unsure of how they were going to operate, and they got turned around and their cap rates came back down.
Right.
We bought some on the up and sold some on the down. That kind of peaked when that country singer song came about.
Walker Hayes.
Right.
Oh, should we do the dance now? Are we ready to do that?
Well, but these things happen in retail, and Family Dollar could be one of these situations where, they're going to restructure that business. Private equity is going to bring in a leadership team. They're going to
Wait a second.
They're going to do what they do.
You're saying the private equity team's actually going to try to make money on this deal?
I believe they are.
That's the plan? Okay. They don't just buy it for $1 billion and then sell it for $500
I don't think
million?
they're buying it for like a little charm on their bracelet. I think they're going to try and turn the thing around.
All right. So then Family Dollar is an opportunity. Like, how are they going to improve Family? I mean, we know what they're going to do. They're going to close all their low producing stores, keep the high producing stores, create value. They'll have a smaller footprint, higher profitability, and they're going to make money. And so that in itself is an opportunity.
Yep.
As long as you're holding the high foot traffic.
Well, no, I was saying like we should buy them after this kind of had their first year. It's going to be the bumpiest, and
Right.
then you look to buy those retail opportunities. But there's plenty of retail opportunities out there right now that are following that suit. Everything happening with the pharmacies, like the CVS, the Walgreens.
Barnes & Noble opened the most stores this year than any year in the last 10
And what in the
years.
world is that? Like,
I
you
mean,
don't buy books at a bookstore anymore. Like,
I think it's more that they're looking at kind of the lounging atmosphere, that like it's a place you can come, you can relax, you can read a book, and hopefully you buy one,
Yeah.
right? But you're spending money at the coffee shop, you're spending money in the store somehow.
it's an experience.
It's
It's
an
back to a
experience.
retail
But it's everything.
experience.
So games, Lego, all sorts of stuff now.
But like Starbucks got rid of their kind of in-store experience. They just moved to kind of like they removed all the chairs. Right? I don't know if you got on a Starbucks lately, but there's no chairs inside. You have to just go through. You walk up, ordering at the leave. So Barnes & Noble, I think, is trying to capture that kind of like lounging atmosphere.
Yeah, and I mean, you can see businesses that are like taking a position of what they think is going to work in the market. If they have a leadership team in place and they can execute on that, and it's a good vision, and you believe in it, there's opportunity to invest there and benefit on the real estate side from that business performing well.
And we've been making that bet with Dollar General for the last 5, 6, 7 years. We've bought over a dozen Dollar Generals, and we're buying more now.
So overall, bullish on retail. I think there's still good buying opportunities out there, and excited to just see. Really, there's plenty of market cycles that happen, and what can be done. I personally think the Walgreens stuff, or the vacant, like great location pharmacy stuff, interesting things will happen there. There's not really a good way to do that at scale with all of them because they're all still just different owners, and it's all individual stuff. But it's gonna be some interesting things that come out of those.
Well, it's malls, it's old drugstores, it's old, even old big box. What do you do with them all? And everything has a different use. Like there's a big box grocery store that was just changed, redeveloped into like a play place, like a bowling, pinball sort of place.
The Party City that went out, they were like, these leases have value because they had a long-term lease with really cheap rent.
Right.
It's like who's going to take that lease and open up a business there?
Right.
And there's an opportunity to do it, and you can be part of it on the investment side just through the real estate, which is pretty neat.
Very cool.
Okay, let's talk about Flex. Again, we've got a couple different asset classes that we operate in, and we're always really looking for, like, what's the angle where we can make something happen. Taking this look of how do you find an underperforming deal and make it performing, that's really been our entire strategy in what we call the Flex space, where we were looking for vacant or underutilized single-story buildings and turn them into Flex. All right, that was our whole game plan. We've got about 1 million square feet of assets that we've done this with. But in general, this is kind of our own unique-ish definition of what the space is. And compared to the true, like if you say just industrial or warehouse in general, this is like a tiny segment.
Yeah, I mean, if you look at the industrial segment, Flex Industrial is give or take 5% of that segment in the Atlanta area. Atlanta's a huge market.
Of hundreds of millions of square feet.
Yeah, hundreds of millions. And if you look at what we're doing, which is more office conversion, so it's more Flex office than Flex Industrial. That's even a smaller segment of it. And we've really set the trend in the northern suburbs of Atlanta. We've done more deals than any other group, and they're doing incredibly well. And I think what we're capturing here is a unique tenant that needs to be infill. So when you look at traditional warehouses or industrial properties, they're usually out kind of on the edge of where suburbia ends and rural starts. When Flex Office is really infill in the neighborhood you want to be in for the plumbers, electricians to service, the homes, in the building that we're in right now. Like we have a pest control company, we have an athletic facility, CrossFit gyms love this kind of space. Pharmacy as well. So you can just do lots of different things for the space, and as long as you have the right zoning, it allows you to kind of capture a lot of the market that's not being captured.
Yeah, so it's been a good opportunity. Our assets have performed well in this space, and we've only been doing this for about 3 years on these conversions. This quarter, our revenue is up 36%. We're seeing very strong leasing. Our occupancy is at 80%. Just our general take on things is like, it's hard we don't want to get too far out over our skis. So we're not really like buying up a ton of vacancy. We'll buy a deal, start the renovation process, make sure we have good leasing, get some traction, get some occupancy before we go to the next one. That's really, how we run our
buying
business.
more than like 1 or 2 vacant deals a year is just
it's a little dicey.
Yeah. So I mean, we just bought 80,000 square feet out in Hiram that's fully vacant, and we're like, okay, it's going to take us a minute to digest this before we dive into the next vacant
we've
one.
got to have really good, leasing prospects and leads on that space before we go look at bringing in more vacant space, quite frankly.
Mm-hmm.
Right. So recently, I mean, we've got 3 of our flex deals that we just fully did our lease out on. And one of the things with flex, especially these like multi-tenant flex spaces, is time is just so important because we have to be able to lease the deal, get all the work done, get the tenant in there. Because one, we're doing work, we lease the deal, the tenant has to do work, we have to help them with that process, and they start paying rent. And we need to, the goal of how we make money, just like in retail, is getting that highest weighted average lease term. In retail, a lot of times there's only one tenant. In flex, we have 5, 6 tenants, so we got to make sure we can get them all in at the same time and really have that pop where we see a high lease term on the building.
Right. Even a lot of these flex deals that we bought over the last 3 years that have been, 67, 80% occupied. We bought a couple of 100% occupied. The market has moved so much in the last 5 years that we're buying, one of our deals over in Norcross, we bought a fully occupied deal at $4 rents.
Yeah.
But the average weighted lease term was 2.5 years. So we had to live 2.5 years with $4 rents, and we're finally able to turn those tenants over and get 10, 11, 12, so even plus $14 CAM. Rents plus CAM.
Yeah.
So, we're great buying opportunity. We like the basis we're buying out. Our kind of target is give or take $100 a square foot. The exit target at the new rents. So we buy a property, whatever rents are at or whatever occupancy, we turn it into fully occupied 95+% and $12 plus rents. We usually exit that for around $160 a square foot. So bases at 100, exit around 160. It's a great spread. The problem is it just takes some time to get there. And in the meantime, you can't really cash flow $4 rents.
$4 rents doesn't work. That's for sure.
So we have to survive that 3-year window of, with reserves and all that and turning the tenants over, bringing new tenants in. And even the downtime that once the tenant leaves, you sign that new lease, you're generally giving them a month of free rent per year of lease. So you sign a 5-year lease, they get 5 months of free rent. So if they leave, it takes you, say, 6 months to lease it. You lease it, then you give them 5 months of free rent. You're 11 months with no revenue.
Yeah.
So you had you had minimum revenue, then you had 11 months with no revenue, and now you're finally stable. So that usually takes really close to 3 years, and we're kind of ending the 3-year window on our first couple assets we bought.
And getting into just a stable kind of cash flow with those deals.
Right, and we're starting a whole fresh new 3-year window on the ones we bought this year. Yeah. So this is very similar to what we saw in multifamily. It took us about 3 years to stabilize the deal. In that third, going into 4th year, is when we really started cash flowing. We really looked to, okay, do we exit, do we refinance, or do we just stay where we are?
Yeah. Yeah, we look at the kind of the risk we're facing in the flex space, or really just what's happening in the market front on that part. We've got really 2 size tenants. We have our couple thousand square feet, and we have our 20,000 square feet flex users. And they both have their pros and cons. We like the small ones because they can make a faster decision. They can move in quickly. However, they're smaller. They're not going to take as much space. They're not going to sign as long of a lease. On the larger spaces, these tenants are taking 5, 6, 7 months to get through the full leasing process and actually move in. And they're going to want a longer lease, which means there's going to be more commissions. There's more TI up front. It's a much more expensive package. But you have a significantly larger tenant who's taking a significantly larger amount of space. It's a trade-off. And what we've seen is we've done our best where we have a building with multiple small tenants, and we can have one of these larger tenants that was there as well. Our Forum deal is a similar situation where we have the 20,000 square foot tenants and a lot of smaller ones, right? Pleasantdale, same thing, smaller tenants with one big suite that we're able to lease out. So those deals, that's also kind of why it takes 2 or 3 years to fully get there, because some of these larger tenant spaces are going to take a long time to come really to fruition and get through.
Right. I mean, if you have the low enough basis, you have the time to kind of build out the space. That 3 to say 6,000 square foot tenant is really the most flexible to kind of get in there fast, sign, say, a 3-year lease and pay the highest rent. But not all deals are designed for that to happen. So we're flexible with the deals. Like not all of them have the devising walls or the columns, et cetera, to break them down that small. But if you have the ability to do that, that's really where, you can really juice a deal by going smaller.
That's like true industrial has like very set metrics of how these whole things are put together.
Yeah.
The flex space is a little more.
It's flex in all categories.
Yeah, it's flex in everything to make a deal happen.
Yes.
Yeah. But if we look at this as a whole, the flex space, it feels like we're probably towards the end of the opportunity cycle in this. There's not a lot of the single story space that's available to even be converted to this. There's definitely more players in the space right now seeing that as an option. And we're not finding a whole lot of opportunities to buy this stuff and do the conversions. So this year we'll have done 2 of them.
One in Chattanooga and one here in Atlanta. But the one here in Atlanta is more, the film studio is more of a true industrial deal than it was like really flex.
Yeah, we're not really converting much there.
Yeah.
So, let's call it 1.5 deals. 1.5. It seems like this strategy could work, and we'll find maybe an opportunity here and there going forwards, but we're probably at probably the end of the best opportunities in these flex conversions, what we see in the market right now.
Yep.
So, okay, piggybacking on flex, some of these buildings we're buying were just true commercial buildings, right? So
Good old office.
Good old office, with the majority of that office being medical. That was really the thing that was a challenge operating in the 2020 to 22 segment was medical space. And we bought a good amount of it at that time. A lot of single users. They're kind of like retail where they have a lot of reimbursements built into the lease.
Sticky tenant.
Single tenant. And it's hard for them to move.
And it has to be in the office. Like there's no optional. You can't work from home if you're running a doctor's office.
Yeah. Right. So we saw that as a good thing. And I think there was just a lot of uncertainty around that in, let's call it like 2021, right? These years there. So there were some good opportunities to pick things up. We have not bought any medical in 2 or 3 years. We kind of see these cycles when they end, and we're like,
Well, medical office was timing. I mean, you bought something that wasn't necessarily thought about, wasn't sexy, and you bought it at the right time, right place. And now,
the tail end of 2020 into really 2021, where really nobody was buying anything. We kind of had a pick of the litter of like what asset class do we see the biggest spread on interest rates and debt. And, to your point earlier on retail, and we saw almost a 500 basis point spread between debt was in the high 2s. We were able to buy medical offices in the mid 8s. So I actually closer to 600 basis points.
Yeah. So it was good. There were good pickups when we got them. And then right now we basically have medical deals that are operating well. However, these are some big expensive tenants that are in these places, and the renewals are very much like,
you want how much?
Yeah, there's a lot. These places are expensive to operate for the medical user. Their expectation if they move is, they're getting $100 a square foot in TI. Our flex users were like, okay, we're going to get 5 or 6 or kind of, where are we at in this space? Medical is $100 in TI, but also they're going to put in even more.
Yeah, they're going to put in another 100. So it's very expensive for them to move. It's very sticky for them. Also, you got to think about like a doctor standpoint. If he picks up and moves his practice, he's got to remarket his whole business. Even though he's an existing doctor, if he goes from one side of town to another, he needs a whole new client base.
Yeah, one of our medical users, we're into a building that we bought for $85 a square foot. And yes, we've put some money in, low hundreds, but they're putting like $250 a square foot into their space. I'm like, that's
right. It's a lot.
You triple the cost of the building.
You can't do that every
just
year.
On your TI, yeah.
Yeah.
So, but the doctor model that works, they can generate that revenue to cover that. It makes sense. They need a nice experience for their customers. So, yeah. But overall, on our commercial side, we continue to see our operating margins improve there. A lot of that is just because as we renew stuff and we get improved lease terms, we have reimbursements that come through. We have annual escalations. So our operating expense ratio there now is around 43% on our commercial space. That's down from 47% last year. So it's going in the right direction. We're positive to see that. And these are really deals. We have long-term leases that are in place, and we have a lot of deals that are really stable, especially our multi-tenant. Some of our multi-tenant commercial, we have everything from doctor's offices to lawyers to accountants, you know. So.
But I mean, one of the things we did in the last couple of years is that we really took up a page out of our playbook with our multifamily business, which was all driven around tenant satisfaction, tenant happiness, and all based around the renewal. So we built an internal leasing team, and really their focus was really how do they encourage the lease renewal. That lease renewal could be in 6 months from now, or it could be in 6 years from now. But how do they start working day one when the lease is signed, or the day that we bought it, and start working every single day towards that renewal to make the tenant happy, give them what they need, and to be there to answer their questions. And so this team is like, it's just a customer service team, and it saves us lots of time, lots of money, by using people, kind of the opposite of AI, right? Of really delivering the customer satisfaction.
And sometimes they don't, some of the medical deals, there's not a whole lot. They don't really want us in their space.
Right.
Similar to retail too. They're like, hey, we got our space, but they do want to know, like, hey, we're here. They have any questions? Like, we can help them along the way. So that kind of just personal reach out goes a long way.
Yep.
Right. So we look at leasing in the commercial side. We've got some good leasing stuff. We've got some bad leasing stuff. Right. The bad leasing stuff is like, okay, right now we've got 2 big tenants that are moving out of their spaces. They've been there a while. And we're looking at, okay, these are going to be big, heavy lifts to turn the space and get someone else in there.
It was interesting. Both these properties, when we bought the property, we interviewed the facilities manager, or really who was ever in charge of really
they all have facilities. They all have an asset management team that's in place. They all have a manager, like a office manager of the locations.
Yeah, the question is like, hey, you've been here for 10, 15, 20 years. Do you like the space? Yes. Do you plan to renew? Of course. We've been here for 10, 15, 20 years. Well, what happened over our ownership is that person changed out. They brought in kind of a new regime that had a different perspective on things, and they wanted to move the space. They wanted to see something different. One of the spaces they wanted to be in the walkable downtown. Our property's 3 miles from there. It just didn't. There was no way to make them happy. So we're working through some of these challenges on these 2 buildings, and it's part of the business.
Yeah. On the good leasing front, we're continuing to see strong demand. We're continuing to see occupancy gains and just really good renewals. We're able to get people into the spaces. Yeah.
One of our buildings in downtown Chattanooga, we've wrestled with getting it leased for years. Part of it because of its location. Downtown Chattanooga is fantastic, but it also, like a lot of downtown areas, has crime and has some issues with it. But really over the last year, they've done a good job cleaning up the downtown, and we've leased 50% of the property in the last 12 months. So we're seeing great momentum there.
Yeah, good momentum on that. It's good working. So. All right. Other part on the commercial side is really transactions. So for us, it's hard to buy stuff right now on the medical side just because the price points, or at least the price points that people are offering, are too high for what we're willing to pay. Really, when we look at our revenue per dollar spent or our cap rate, or kind of pick any metric you want in there, they're just too expensive for us. But on the same side, selling isn't really happening. We got a couple of our medical deals that we're not really getting any traction on, that we're coming up on around 5 years of holding it.
All the deals that we have listed right now, the office deals, even the medical office deals, the government deals, they're getting the least amount of traction right now. The things that get the most attraction getting the most volume right now are major branded retail and stable flex. So not the, buy vacant and fix it up and sell it, but like, here's a 10-year lease flex. People want that because it's already in place. You've already created the value, and somebody's got a rent check for 10 years. So that's what's kind of getting the volume right now.
Yeah, doesn't seem the market is really valuing the variability or the flexibility of a multi-tenant building. Like, what we like about a multi-tenant building is it doesn't put all the liability on one tenant on that big renewal. We've seen some benefits on that. We've seen some risk with that. But the market seems to be hedging towards the credit and.
Yeah, and I think about it like, multi-tenant flex is almost like an apartment complex, only your tenant's different. So with an apartment complex, you can kind of keep it mostly full, and then your risk is, as you've talked about, taxes and insurance. Multi-tenant flex, I guess you still have some tax and rental, tax and insurance risk. Sometimes, or hopefully most of the time, that's passed to the tenant, so you remove that risk. But then you're talking about if 1/5 or 1/4 of your space goes vacant, that's a bigger hit than like 1 unit out of 100 units going vacant. So it's just a different game.
Yep. But so overall, this medical opportunity, we saw that kind of for our approach, right? That ended about 2.5 years ago on the buy front. We feel like the flex stuff is in a position where it's coming to an end of real opportunities at scale to come through. Retail, we have just different things that pop up on where those opportunities exist that we're continuing to try and find. And the private debt side is right now where we see like, hey, there's a number of opportunities we could take advantage of right here. So the business definitely like ebbs and flows into like where these market opportunities are at. And we're always looking at how do we find a way to operate and provide the returns that are needed in each segment. Okay. Well, that wraps up our third quarter overview. Thanks for tuning in. We have all of our end of quarter reports. If you're an investor that go out on the 20th every quarter. So consistently have all those details from every single property that we own. So thanks for watching, everyone.
So long. Goodbye.